I'm Sabri Saran from the Mint's personal finance team, and we are talking about money. Traditionally, Indians buy gold every Dhanteras, irrespective of the prices, as it is considered auspicious. Gold prices have fallen sharply in the past few days, and it might seem tempting to buy the yellow metal this Dhanteras. But buying some jewelry isn't the only way to accumulate gold. There are different forms in which you can buy gold. Let me tell you about 4 different ways in which you can buy gold this Dhanteras and its major pros and cons. First is the sovereign gold bond. Sovereign gold bonds are issued by the RBI on behalf of the government. The bonds are denominated in multiples of 1 gram of gold. The maximum one can invest in is 4 kg in a financial year. The tenure of the bonds is 8 years with the exit option available after the 5th year. They pay a fixed coupon. This coupon rate might change issue to issue and is currently at 2.5%. The issue price of the bonds is fixed at the simple average of the closing price of gold of 999 purity or 24 karat gold on the last 3 working days of the week immediately preceding the subscription period and can be redeemed at a price that is the simple average of the closing price of the last 3 days. The bonds are listed on the NSE and the BSE, and investors can buy and sell the bonds on the stock exchange after the subscription period is over at the current market price. You can buy the bonds using cash up to Rs 20,000. Investors using online modes are eligible for a 50 rupees discount on the issue price. The bonds can be bought from banks, stock exchanges, designated post offices, and other notified sources. Remember, there is no capital gains tax on bonds held up to maturity. Second is gold ETFs and funds. Mutual funds offer exchange-traded funds that invest primarily in physical gold, with each ETF unit typically representing 1 gram of gold. The equivalent physical gold is held with the custodian bank and valued periodically, as per the SEBI guidelines. The performance of gold ETF is benchmarked against the domestic price of gold. Ideally, the returns from the scheme should match that of the benchmark, but there may be variations on account of the cash holdings and the costs involved in managing an ETF. It could also be because gold ETFs are now permitted to hold financial instruments such as exchange-traded derivative contracts and the gold monetization scheme. ETF investors must have a demat account into which the units are credited and a trading account with a broker to buy and sell the units at the market price on the stock exchange where it is listed after the new fund offer for the ETF closes. This may be a constraint for some, and mutual funds have worked around it by offering gold funds which are mandated to hold the units of gold ETFs. Investors buy units of the gold funds just like any other mutual fund, and these funds invest in the units of the gold ETFs to give investors similar exposure to gold. Number 3 is physical gold. Traditionally, gold has been held in the form of jewelry, coins and bars. If you hold jewelry, you also have to pay for the making charges which get deducted when you sell it off. This can be as high as 15% of the price of gold. The government has launched the sale of BIS hallmark gold coins weighing 5 gram and 10 gram and gold bars of 20 gram of 24 karat purity through Metals and Minerals Trading Corporation of India Limited outlets. The coins are available at MMTC outlets and designated banks. MMTC also offers the option to buy back these coins or bars at the prevailing price, thus offering investors liquidity. Then there are gold saving schemes offered by jewelers where buyers make periodic deposits and use the sum to buy gold after a specified period. Usually, such schemes offer a discount or a similar benefit. Number 4 is digital gold. This is a facility offered by issuers such as MMTC PAMP, Digital Gold India Private Limited and others to accumulate gold by buying online through institutions, broking houses and payment platforms such as Paytm, Stock Holding Corporation of India Limited, among others. The scheme allows investors to accumulate gold by regularly buying gold of value as low as 100 or even lower as prescribed by the issuer or distributor. The accumulated gold is kept in secure storage in the custody of MMTC PAMPL with full insurance, and investors can ask for delivery in the form of coins of different denominations, the minimum delivery being 1 gram. The gold will be kept in storage for a maximum period of 5 years, within which period the investor has to take delivery. Remember, Don't buy gold as a strategic allocation to meet goals. The returns are extremely volatile and you may find that your investments are in the red when you have to exit. Buy gold for some stability it can provide to the portfolio's returns when other asset classes may be doing badly. However, the exposure should not exceed 10 to 15% even in those conditions. All the modes of buying gold have their pros and cons, but financial planners say sovereign gold bonds are the best way to buy gold at present. They are suitable for investors who may not need the funds in the short term. Hope you purchase your gold smartly this time. That's all from us on this episode of Why Not Mint Money. Happy Dhanteras.